Hello everyone. Today we're going to talk a little bit about how far behind the curve central banks are in an environment that they are less certain about the macroeconomic environment, but more importantly about inflation expectations. The Federal Reserve is about 300 basic points behind the curve compared to where it should be in terms of rates, if we consider the level of unemployment, the level of economic growth, and the level of economic activity in general. That is very dangerous, and we need to see a much more robust, a much more solid action from the Federal Reserve to avoid entering into a market that gets so obsessed about rates that it ends up working the other way around. What does that mean? What that means is that if the Federal Reserve doesn't get back to normalization when it's needed, the markets might start to become more concerned about macroeconomic environments, more concerned about the general risks, and the Federal Reserve is going to find itself without tools. It needs to go back to normalization. That is why it's so important what we are seeing in the US, that there is this legal and parliamentary and also in the Senate requirement to go back to a Taylor rule type of policy by which the Federal Reserve doesn't go so behind the curve in its policy. So this is an important factor. This normalization is essential to keep markets healthy, to keep markets reflecting fundamentals which have been stronger after we have seen both the results at an earnings level, but also at a revenue level, which is also important. So the results are actually much better than what we expected, and the economy is showing very, very strong levels of improvement, both in the job reports, but also in consumer confidence and in business confidence. So let's keep monitoring this, but the Fed needs to really step up in this environment in order not to create a situation in which markets and investors become concerned, thinking that the Fed does not take action because they know something else and they fear something that is much bigger or much riskier. Let's move to Europe. If we move to Europe, it's not dissimilar. The European Central Bank is not going to change its monetary policy, but it's also quite behind the curve. And being behind the curve when the European Union is growing, is actually growing more than Europe. And unemployment is also at around 6% in the European Union is quite dangerous, because all this increase in credit, all this increase in monetary supply is becoming the source of bubbles, and particularly in sovereign bonds, which are extremely low at this level. Spain, Portugal, many others are issuing at 12 months with rates that are completely out of range with the real risk. Therefore, what we need to think is, what is improving? We're seeing an improvement in both economic growth, employment, investment, credit growth, and also a much healthier set of results than what we have seen in the past. Therefore, what we need to do is to pay attention to fundamentals. They are improving, and to use the excess liquidity that we have built up in the last months to buy selectively into a market in which finally monetary laughing gas is out of the equation, and where we can see this improvement of inflation, of results, of economic growth transferred to the fundamentals and to the opportunities that can be set selectively both in the US and in Europe. Thank you very much.